Say you put $1,000 into something, and it has a genuinely terrible year. It drops 50%. You're down to $500. A 50% loss, taken from 1,000, costs you $500. Painful, but the next year, things turn around. It bounces back, and gains 50%. You lost 50, you gained 50, so you must be even again. Except 50% of 500 is only 250. So you're sitting at $750, still down a quarter from where you started. The losses and the gains did not cancel. To actually claw back to even, that 500 didn't need to gain 50%. It needed to double, a full 100%. And that gap between the 50 you lost and the 100 you need is the whole story. Percentages are not symmetric. And 50% is the gentle case. The deeper you fall, the more violently the climb explodes. Lose 90, and you need to gain 900 just to get home. The reason is almost sneaky, and it comes down to a single question you have to keep asking. A percentage of what? Your 50% drop was measured against $1,000, everything you had. So it cost you a hefty $500. But your recovery gain is measured against the new, smaller $500. 50% of that is only $250, half the dollars. To lift $500 back up to $1,000, you don't add half. You have to double it entirely. The loss and the gain were the same number, 50, but they stand on completely different ground. After a loss, you always have less to grow from. And this asymmetry gets ugly fast. Lose 10%, and you need about 11 to recover. Barely noticeable. Lose 20%, and the gap opens a little wider. Now you need 25% just to get back to even. Lose 50, and the gap yawns open. You need a full 100%, a clean double, to undo it. Lose 80%, and it turns savage. You now need to gain 400%, a fivefold rise, just to break even. And lose 90%? You need a staggering 900% to make your money 10 times over, only to get back to where you began. The deeper the hole, the more impossibly steep the climb out. The gap isn't growing steadily. It's accelerating. You can write the whole pattern in one tidy line. If you lose a fraction L, the gain you need to recover is L divided by 1 minus L. Check it. Lose a half. L equals 0.5. Then it's 0.5 over 0.5, which is exactly 1. 100%. The formula nails it. Now watch what that fraction does as L creeps toward 1. The bottom 1 minus L shrinks toward 0, and dividing by something tiny sends the answer screaming upward. That's the shape. Near 0, a loss and its recovery are roughly equal. Out in the land of big losses, a disaster on the way down demands a miracle on the way back up. This is exactly why serious investors obsess over a single number called drawdown, how far you've fallen from your peak. A portfolio that drops 50% in a crash has to double, from that lower point, just to return to the high it already hit. And notice, doubling there earns you no profit at all. It only repairs the damage. You're running hard just to stand still. And doubling your money can take many, many years of patient compounding. The recovery is a long, slow, uphill grind. That's the cruel asymmetry of time, too. The loss is instant, one bad day. The climb back can swallow years of your life. Now you might hope the order rescues you, maybe a good year first, then a bad one, comes out differently. It doesn't. Gain 50% then lose 50%. And you don't land flat. 1,000 becomes 1,500, then loses half, down to 750. The exact same 750. Up then down, or down then up, either way you've quietly lost a quarter of your money. And the algebra says why? 1 plus r times 1 minus r equals 1 minus r squared, always a hair below 1. The swing itself is what costs you. And that 1 minus r squared is a clue to something deeper. Volatility itself, the wild swinging up and down, silently eats your returns. Mathematicians have a name for the trap. The thing that actually compounds your wealth is the geometric mean, and it always sits below the simple average. So two portfolios can post the exact same average yearly return, and the calmer, steadier one leaves you measurably richer than the wild, lurching one. The swings aren't just stressful to live through. They are, quite literally, expensive. There's even a rough rule for the toll: the drag is about half the variance. The more your returns scatter, the more this hidden tax quietly schemes off the top. History makes all of this painfully concrete. In the 2008 financial crisis, the U.S. stock market fell about 57% from its peak. To recover from a 57% loss, you don't need to gain 57. By the formula, you need to gain about 130%. And it took roughly 4 years for investors to climb all the way back to where they had been before the crash even started. Now push it further. Crypto routinely drops 80% in a bad cycle, a number stock investors rarely see. From down 80%, breaking even isn't a comeback. It's a 400% moonshot, a five-fold rise, just to get back to zero. The deep hole isn't a math curiosity. It's where real people, in real crashes, have actually found themselves. And it isn't only markets. A store marks a code up by 50%, then proudly slaps 50% off, and shoppers assume it's back to the original price. It isn't. 50% off the inflated 150 lands you at 75, below where the $100 code started. Down by some percent, then up by the same percent, never returns you home. You always land a little poorer than you began. It even hides in your paycheck. Take a 20% pay cut, and a later 20% raise will not restore your salary. To get back, you need a full 25. The same trap hides in stats and headlines everywhere. A figure that falls by a percent and then rises by that same percent has not actually recovered. It's always short by exactly R squared. Small for tiny swings, but for big ones, that little squared term is the gap that quietly empties wallets. So keep one rule of thumb in your pocket. The gain you need is your loss, divided by 1 minus your loss. Lose a third of your money, and you need to make back a half. Already the climb is bigger than the fall. Lose a half, and you need a whole, 100%. The gap has caught up to the loss. Lose 2/3, and you need to triple what's left. Now the recovery towers over the loss that caused it. Each step you slip down the cliff, the rope you need to climb back up gets dramatically, disproportionately longer. Which lands us on the real lesson, and it's about defense. Because losses and gains are not mirror images, the math quietly rewards a boring strategy. Protect the downside. Avoiding one catastrophic loss is worth far more than chasing one spectacular gain, because the spectacular gain only ever has to undo what the catastrophe did. Stay shallow, and you barely need to recover at all. Fall deep, and you're forced to perform a miracle just to break even. In a world of asymmetric percentages, the surest way to win is almost embarrassingly simple. Just don't lose big.